Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 25th of September. I'm Daniel Lam, your host for the podcast. I did a TV interview earlier this week. I was asked about Chinese equities and what to buy there if there were to be pullbacks. And then suddenly I recall back in March last year, there were many skeptical comments online responding to my interview clip with the very same TV station when I said that Chinese equities were not so bad. Well, at that time, the Hang Seng Index was at 17,000 versus the index hitting 27,000 earlier this month. Well, now it is natural for investors to be asking, is this level too high now? Should we be getting out? Well, back in, let's say 2023, there were estimates that the potential growth in China could slow to 4% by 2028 and 3% by 2035. Now, this total factor productivity, TFP, the growth plunged by 3.1% year over year in 2020 due to COVID-19 disruptions. That's down from an average of plus 1.1% in the 5 years prior to the pandemic. So although this TFP growth did rebound in 2021, its sustainability was challenged by various economic and policy shocks. But there has been pickup in the TFP, and an important element is technological progress, including AI adoption. Now, there are new estimates that the total factor productivity growth has been recovering steadily over the past few years, and China's export competitiveness reflects this recovery. Look at the resilience in its external sector amid the tariff war. Now, looking at a longer horizon, there have been 3 significant TFP cycles in China, and they all match with major reforms. So, for example, the economic reforms and opening up of the economy in the early 1980s, the state-owned enterprise reforms in the 1990s, and China's ascension to the World Trade Organization in the early 2000s. Now, each of these periods featured high TFP growth amid economic liberalization and market-oriented reforms, and that allow for more efficient resource allocation. So China's continued push on structural reforms, coupled with fast technological development, could boost further TFP growth in the long run. So we continue to believe there is some follow-through in Chinese equities. So after a 1,000 points correction in the Hang Seng Index, it found strong support just above the 25,800 level, the very level that we talked about in our weekly market view publication last Friday. So we would be advocating buying Chinese equities on dips should the index retest this level again, on the tech sector, as well as stocks in the light consumption areas, such as services, traveling, and so forth. That is all from me for today. As always, if you enjoy these podcasts, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.